Good morning. It's October 7th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. It comes every Monday. If there's commentary intra-week, I'll either put it on LinkedIn or on X, formerly known as Twitter. The handles are Herb Morgan on LinkedIn and at ETF_strategist on X. Presentation has been prepared by us, Cantor Fitzgerald Investment Advisors. We are an SEC registered investment advisor, and this is designed to be used by both financial advisors and individual investors, but each are expected to maintain and make their own investment decisions. Nothing contained in the presentation should be treated as investment advice. No tax advice, no recommendations for the purchase or sale of any securities. Last week, we had yet another positive week for the S&P 500 as big cap stocks maintained that bid. It wasn't a big week. They were up about 1/3%. But the total for the year to date through 3 quarters only, almost 22% on the S&P 500. We know the rally has been broadening out lately, and we're seeing participation now, not so much last week, but participation from mid and small cap stocks. Those indices are now having a good year. Nothing like the back-to-back 20% plus years that the S&P has achieved, although this year's not over. Give it all back, right? Anything could happen between now and the end of the year. International markets were down a little bit last week, but on this big run-up in Japan based on massive fiscal and monetary stimulus, I said Japan, I meant China. The big run-up in China, it's taken the emerging markets up about 4% on the week, now up almost 18% on the year, clearly catching up with U.S. big cap stocks. Though, some of the inflation data that we've got, whether it's subcomponents of different things or actual inflation data itself, has been a little hotter than expected. Things like labor strikes have contributed to that. And inflation expectations have been on the rise, even though the Fed has cut interest rates, the Fed funds target rate by 50 basis points. As such, if inflation is on the rise, you get a little bit of a sell-off in bonds. We've now got 10-year Treasury back over 4%. High yield, though, is strong on the strength of the economy. No real sign of a recession in sight. Let's move into some of the data from last week. Let's start with the Chicago PMI. Chicago PMI rose from 46.1 to 46.6. I'm going to just, make my cursor, my little red dot, go across here at 50. Above 50, expansion. Below 50, contraction. We've been in contraction in Chicago for about 2 years. New orders fell, production fell, both in contraction. Employment rose, but still remains in contraction. So nothing particularly good there. And then we move on to the national readings of manufacturing. We got both the S&P Global reading for the month of September. We got the final reading. If you remember last week, I brought you the flash readings. We got the final readings from both S&P Global and the Institute for Supply Management. S&P Global says manufacturing really dropped off again, came in at 47.3, right in line with the 47.0 estimate. Moving on to ISM, you can see we've been 2 years negative manufacturing there. Unchanged from August to September, 47.2, kind of in line with the 47.5 estimate. New orders rose, but it remained in contraction. Employment declined and remains in contraction. But as we point out every time, manufacturing is about 15% of the U.S. economy. Far, far, far bigger is services or non-manufacturing. The non-manufacturing side of the U.S. economy is roughly 85%. So when the biggest component continues to grow and grow at a pretty rapid pace, the net effect, the ultimate, the amalgamation of the two is that the economy continues to grow. U.S. S&P Global Services PMI came in at 55.2, right in line with the expectations of 55.4. You can see that's 5 months in a row at this 55 level. If I was a voting member of the Federal Reserve talking about cutting interest rates at a time when we are fighting inflation, I would be looking at this 55 and saying, well, what am I worried about an economic slowdown for or a slowdown in employment? I could cherry pick and look at manufacturing, which is clearly in a slowdown. But on the services side, not so much. Manufacturing could be secular, it could be competitive, could be price differentials in different markets. One of the themes of this year's presidential campaign, or the cyclist campaign, is unfair competition from foreign manufacturers, where governments either have subsidies to manufacturers or incredibly low cost labor or lower regulations. And that may be one of the things that's hurting the manufacturing sector in the U.S. But I would not put that as more of a broad secular look at the U.S. economy, where I see the services sector continue to increase. And then from the ISM's measurement, which had not yet gotten to 55, it got to 55. So we accelerated there. The service sector, according to the ISM reading, rose from 51.5 to 54.9, called 55, well above the expectations. New orders really jumped, 59.4. Business activity, 59.9. These are, you start getting in the high 50s, getting close to 60. You're talking about inflationary pressures reigniting. So the biggest part of your economy is the service sector, and you're seeing these kind of numbers at a time where the Fed is arguing that they've got inflation well under control, and we're on a path to the target rate of 2% core PCE. So because policy works with a lag, we can move from there, and we can get ahead of potential job losses by starting to cut short-term interest rates now. It's a very risky thing they're attempting. Their view is probably, hey, we're not easing, we're just being less restrictive with our Fed funds target rate. And I think that's a fair statement to make. Moving on to construction spending for the month of August, fell 0.1%. You can see the year over year on the right-hand side, down, more than 5% on a year over year basis. A lot of this has to do with, of course, interest rates, rate financing of construction projects, of course. Job openings, or JOLTS, had a big surprise. It was estimated to come in at 7.7, came in back over 8 million. You can see there's the 8 million line right there on the right-hand side, still well above the number of job openings pre-pandemic. Obviously, the reopening took us to that unsustainable level of 12, but 8 million job openings far exceeds the number of unemployed and underemployed workers in the U.S. economy. That's also inflationary. Automobile sales still kind of stuck below that 16 million. Pre-pandemic, the last cycle, you can see we were in that 16 to 18 million range, very, very consistently, automobile sales. And then obviously, the drop off during the pandemic, we've recovered, but we really just remained below 16 million, came in at 15.77, right in line with estimates there for the month of September. We also, because it was the first week of the month, first week of the quarter, we start looking at the labor markets, the jobs reports, and how did they all do in September. Let's start with the weekly claims, though. Initial claims for unemployment last week came in at 225, right in line with the estimate there of 221. Continuing claims, 1.826 million. This is a healthy labor market. I'm sounding like a broken record. Anything in the 200s, the low 200s especially, is a very healthy, strong labor market. We're not getting big layoffs. In fact, we're having, we had the strike last week. This is, we have the Boeing strike as the week before, still going on. These are signs that labor pricing is strong. That means labor costs go up. That ultimately translates into a little bit more inflationary pressure, all things being equal, in the economy. The two national reports we got first ADP, Automatic Data Processing. They say that the U.S. economy added 143,000 private jobs in the month of September. The estimate was for 125. Services jobs were up 101. Goods producing jobs also gained, though, at 42,000. So good number, very strong number, no weakness in the labor market. We follow that up with the Bureau of Labor Statistics jobs report. And they say, hey, we added more than you think. We added 254, which was over 100,000 more than estimates. Add that to the 159,000 in August. It's a big couple of months worth of gains. And the prior 2 months revised up for a combined 72,000. The unemployment rate dropped to what most economists would consider a solid full unemployment rate, and participation stayed the same at 62.7%. 7. Factory orders for August fell 0.2%, but you got to back out transportation, and they say they fell 0.1%. Everybody asks me, I think not everybody, many people ask me very frequently, what are the big risks? We've got strong financial conditions, strong labor market, a lot of access to capital, plenty of liquidity in the system. The economy's doing well, jobs are plentiful, interest rates are a little high. That's impacting residential real estate and other commercial and construction businesses. Yes, of course. But, what else is out there? What are the big risks? And of course, there are many, right? We can have a pandemic come from nowhere, unseen geopolitical risks, weather-related risks that we see now in the mountains of North Carolina, hurricanes coming onto Florida and moving up north and going inland. All of these things are risks. Well, I think one of the biggest risks today is the Middle East. The Middle East is boiling over. It's at the hottest point that it's been in a very, very, very long time. And I think, to boil it down, okay, yes, Israel is not a NATO member, but I can't imagine the U.S. doing anything other than being in 100% full defense of Israel in the event of strike. And we did have a big strike last week. 180 missiles came from Iran. The technology of the United States military that was there and the technology of the Israeli Defense Forces was largely successful in taking that down. But and people say, well, is Israel going to hit back? How hard will they hit back? What will they do? Will they hit oil facilities? Will they hit nuclear facilities? And I think to understand it and understand, the fact that Israel is so small in an area that is surrounded by many, many nations and many, many factions that would really like to kill them, to see them wiped off the face of the earth, and that Israel is a democracy. It is a country of religious freedom. It is very much connected to the United States. And then there was there's this overarching fear, if you live in Israel, hey, we can shoot down missiles, traditional missiles that come in from Iran or other places, and we have strong military and defense. But there's one thing we just will never accept, and that is a nuclear capable Iran with a nuclear weapon. This is something that is probably closer than most of us would like it to be. And that is why I think part of the reason things are building up. So if you go back to between 2018 and today, if you remember, the U.S. had along with 5 other major powers, had a deal with Iran. We're going to help you. We're going to let capital flow. We're going to take away some of the treasury restrictions. We're going to do different things here. We're going to allow your country to do better. But you have to agree to these terms to not move any closer to obtaining a nuclear weapon. Because if Iran has or is about to have a nuclear weapon, Israel will have no other choice but to destroy that capability militarily. And nothing would be off the table in doing that, because Israel's survival is dependent on Iran not getting a nuclear weapon. So between 2018 and today, Iran has taken their nuclear enriched capabilities, enriched uranium, to 84%. The deal they had with the U.S. was to cap it at 3.7%, 3.67, the amount needed to produce energy for their people. 90% is the amount needed to create a mass nuclear weapon, a weapon of mass destruction. Because Iran was violating that 3.67 number, the U.S. pulled out of that nuclear treaty in 2018. So beginning in 2019, Iran continued to enrich uranium production. It went 4 times past the 3.67 limit. In January of 2020, Iran announced it will not abide by the restrictions. They just told the world, I know we have this deal with the other 5 countries and the U.S. is out, but we're just not going to abide by them. Later that year, November of 2020, the head of Iran's nuclear program was assassinated. In January of 21, Iran continued to enrich uranium, getting up to 20% in an underground facility, which is a major violation. In April of 21, they got to 60%. By May of 22, they had stockpiles of this enriched uranium at 18 times the amount allowed under the 2015 deal. In June of 22, Iran removed security cameras that the parties to the agreement, the nations to the agreement, have part of the agreement. You have these cameras so we can see what's going on, even though we're not there, and then we have inspectors. They just removed them. So we don't know. It's hard to say where they are today. We don't know, but in terms of publicly available information. So I think a risk is that they're further along than we know. And Israel finds out, and Israel understands through U.S. intelligence, European, Israeli, and action is taken. That will destabilize the region. That will destabilize the capital markets, and that will cause a decline in the value of portfolios. But I always say this: geopolitical events tend to hit portfolios quickly, sharply, and then the recovery tends to be very quick as well. Very different from a recovery from a recession or from a global financial crisis. When geopolitical events start to see resolution and start to see the light at the end of the tunnel, then the markets come back very rapidly. So as investors, even knowing this tremendous risk is out there, I don't think there's a way or a need to trade into it or around it in any way. The bottom line is, I believe we should be aware of it, know it, understand it, hope that our leaders are doing the right things in all the different countries and all the different political parties, and we should stay the course and invest for the economy that is. Maybe next week we'll get into a different geopolitical risk or just a different risk. One of the ones is the Tax Cut and Jobs Act of 2017, the expiration of those very expansionary components. Maybe we'll talk about that next week or something else. We'll see what happens. Okay, this week we don't have a lot. We've got consumer credit, is business optimism, trade deficit, minutes from the last FOMC meeting, not a big deal. CPI, PPI, those are bigger deals. But what we do have this week is we start earnings season. We always start with the financial companies. So we've got Wells Fargo, JP Morgan, BlackRock, world's largest money manager. But we've also got the industrial company Fastenal, we've got Delta Airlines, and we've got a consumer company in Pepsi. All of that starts this week. Then we move deep into earnings. And of course, we'll get into tech and communication services and all of those things. And the way the market's behaving, it sure looks like they feel pretty good about this quarter's earnings season. Thanks, everybody. I will be back to you again in 1 week.